Hello Scholar, today we are going to talk about chapter number 6, which is merchandise inventory. It is a continuation from chapter number 5, and we are going to discuss inventory in more detailed. Basically, what is inventory, what happens to inventory, how we track inventory. So accounting principles and controls relate to merchandise inventory. Control simply means we want to make sure our inventory is secure. So having controls, policies, and procedures, we make sure that our inventory is secure and is used for the intended purpose. Accounting principle help accountants classify and report items on the financial statement. So we classify and we report. Report means we are reporting the information on the financial statements. So what does it mean by classify? Classify in this particular chapter means what is inventory and what is not inventory. So what is inventory and what is not an inventory? So we are three accounting principles that we talk about, which is associated with inventory. One is consistency, disclosure, materiality, and accounting conservatism. These are the principles that we have already discussed in chapter 1. So we are going to revisit these principles in more detail here. So what is the consistency principle? That a business should use the same accounting methods, procedures from period to period, means year to year, month to month, quarter to quarter. Same accounting method, because we're going to later learn in this lecture that there are 3 or 4 different ways we can keep track of our inventory. It helps investors and creditors compare financial statement from one period to the next, so they can see what you have been doing using these inventory that you are keeping on your financial statement, how much inventory you are purchasing, how much you are selling, and at how much inventory you are holding in your hands at any given time. Is your inventory slow moving, or is your inventory fast moving? Of course, if it is slow moving, basically you are taking too much time to sell the inventory and you're not making much out of it. But if it is a very fast moving inventory, that means you are constantly buying and constantly selling, hence increasing the profitability, revenue and profitability of the firm. If changes are made in accounting methods, these changes must be reported, generally in the notes to the financial statement. If you ever change your method of counting or evaluating or valuing your inventory, if you ever change it, you should disclose this in your financial statement with the information what difference is it going to make on these current financial statements when you make these changes. Disclosure principle. Financial statements should report enough information for outsiders to make knowledgeable decision about the company. If a company is not making disclosure or is not letting me know what exactly they are doing and what are their finances, what are their revenues, assets, liability, equity, and expenses are, as an investor or as a creditor, I will not be able to make a sound decision in my benefit whether I should invest in this company, whether I should loan money to this company, and I may end up losing the money that I have invested or loaned to this particular business. Information should be relevant and a faithful representation. It simply means relevant means it should be relevant in my decision making, and a faithful representation of, for example, what is the faithful? You have inventory in your warehouse which is worth $10,000. Instead, you put that you have $100,000 inventory. It's a difference of 10, but it makes a huge difference for the decision maker whether to make an investment in this company or not, because this 10,000 and 100,000 are two materially different number. And let's reach to our next topic, materiality concept. States that a company must perform a strictly proper accounting only for items that are significant to the business. So for example, this is a $10,000 inventory. That's the value. If I say it is $10,100, it's not a huge difference. 10,000 and $10,000, 100, it's not a huge difference. That's not a material difference. But if I say instead of 10,000, I say it is 15,000, that's a material difference, because 10,000 and 15,000, we are changing, a number too big. That was material. So the term materiality, it's relative. So for this company, 100,000 is material. For this company, it's 10,000 material. So different companies have different material and numbers. Conservatism means should report the least favorable figures in financial statement when two or more possible options are presented. For example, you have an inventory worth $15,000 in your hand. You go to the market and find out the fair market value of this inventory is $14,000, and what you have paid, if it's $14,000, but you have paid $15,000. So that means you are sitting on a $1,000 loss. So that's a loss of $1,000. But if you go to the market and you find out your inventory is $16,000, you are sitting on a gain of $1,000. So this conservatism rule says if the fair market value goes down, then you will bring your inventory from 15,000 to 14,000. But if it goes up, you will not do it, because markets may or may not have this correct information. So you always take the loss, but you always hesitate in taking a gain when it comes to reporting the inventory. In this chapter, we are only talking about one asset, which is inventory, and this rule applies only to inventory. Anticipate no gains but provide for probable losses. So anticipate no gain but provide the information for the losses. Record an asset is the lowest reasonable amount and a liability at the highest reasonable amount. Means if you have an asset such as inventory, always report at the lowest reasonable amount and liability always at the highest reasonable amount. This is the rule of conservatism. When there is a question, record an expense rather than an asset. If you're not sure, you should record it as an expense. That means asset has already been used. Choose the option that undervalues rather than overvalues your business. Basically, what you are saying that you should not project your business beyond its value. The rule of conservatism says that if you think your asset is $1,500 but you are not sure, and the market is saying is instead of $1,500 is $1,475, you should go with $1,475 instead of $1,500. And again, these rules apply mostly here to the inventory. So what kind of controls we have over merchandise inventory? What does it mean by control? Controls is something in general that stop waste or loss. So we are trying to make sure that we have some controls over our inventory so we do not anticipate any waste or losses in the future. Okay. Inventory purchase and sales are properly authorized. Means when you are going to purchase an inventory, the person who is making the decision about purchasing the inventory, he should have the authority. And the same person and another person who is making the sales decision to selling someone on credit, he or she should have authority. Usually in most cases, the purchase and the sales department are two totally independent, separate departments, and they don't interact much between them. Ensuring inventory is purchased with proper authorization, tracking and documenting receipt of inventory, recording damaged inventory properly because it's a loss, performing physical counts of inventory annually or quarterly, because some firms also do on a quarterly basis, recording and removing inventory when sold. Means you should deplete your inventory when you have sold. Like last time I gave you in the previous chapter example, when Walmart sold one shampoo and you go to the checkout counter, that it deletes one less shampoo in the inventory because they just sold it. Determining the cost of merchandise inventory, and we're under perpetual, we have talked about it. Then the ending merchandise inventory is number of units on hand multiplied by the unit cost. So number of units, suppose you have 100 and the unit cost that you pay is $10. So that means your ending merchandise inventory is 10 multiplied by 100 is $1,000. At the end of the period, determine the units sold during the period and assign dollar amount to the cost of goods. So cost of goods sold is this formula, number of units sold into unit cost. Make sure you copy these formulas on a piece of paper. Just have all the formulas at one place. So when you are doing either homework, quizzes, or exam, you can consult with these formulas. Determining the cost of merchandise using a perpetual system, we are going to use 4 different methods. A specific identification method, first in, first out, last in, first out, or weighted average. This is usually used for very precious items. We are talking about that they are in like 6 or 7 figures. First in, first out for almost every item. Most of these items, like the example of a can of Coke or bottle of water. These weighted average is the first in, first out, means simply the inventory that you are buying, you are going to sell first. So you're going to sell the old inventory first and keep the new inventory in hand. Last in, first out, you're going to sell your new inventory first and you're going to keep the old inventory in hand. Weighted average simply means you take the weighted average of the old inventory and the new inventory and you come up with the cost. A specific identification method based on a specific cost units of inventory, basically for precious items like a $50,000 watch or $500,000 yacht. First in, first out assumes the first item purchased or the first to be sold, means old inventory sold first. Cost of goods sold is based on the oldest purchases. Ending inventory reflects current replacement cost or new inventory. Okay. Cost of goods available for sale is the total cost is spent on inventory that was available to be sold during a period. In the last in, first out method is just the opposite of LIFO. New inventory is sold. So the cost of goods sold reflects current replacement cost or new inventory. And ending inventory, oldest items or old inventory. Income statement, cost of goods sold is higher under LIFO. This is a very important point and it will help you in the exam. Cost of goods sold is higher under LIFO than under FIFO when costs are rising, and net income is lower under LIFO than FIFO when costs are rising. And this cost of rising is the assumption here that the costs are always rising, means due to inflation the cost is always right. For example, right now we are facing a lot more inflation, but usually the Federal Reserve Board try to keep the inflation at 2%. So means the idea is the prices is going to rise every year about 2%. So today what you are purchasing for $1, it will be available next year for $1.02. When costs are increasing, FIFO inventory will be the highest and LIFO inventory will be the lowest. So which inventory we talking about? We talking about FIFO inventory will be the highest and the LIFO inventory will be the lowest in the balance sheet. What we report in the balance sheet, we report in the balance sheet the ending inventory. Because in FIFO, you are keeping the new inventory and selling the old inventory, so ending inventory will be highest. In the LIFO, your inventory will be lowest because you are keeping the old inventory in hand and selling the new inventory, new items. How do we value merchandise inventory? Using lower of cost or market value. Sometimes it says LCM, lower of cost or market value. So what is lower between the cost you have already paid in the past and market value? So lower of cost, so lower cost already paid or market now, price now or at this moment. Okay, so which one is the lower? You're going to report this on the balance sheet. So requires that inventory be reported in the financial statement at the lower of the cost or its market value. If the cost is $100 and the market is 110, you will report this at 100, not 110. If the cost is 100 and the market is 90, now you're going to report at 90 because it has lost its value. Market value generally means the current replacement cost. Recording the adjusting journal entry to adjust merchandise. So what kind of journal entry? What we do, we basically do this because we only take losses. So debit loss on inventory and we credit the inventory account. That goes to income statement and this reduces at the balance sheet, the amount. Measure the effect of merchandise inventory errors on financial statement. An error in inventory can lead to errors in other related functions because the ending inventory number is used in other computation. When ending inventory is incorrect, other numbers will also be incorrect. So what numbers? If ending inventory is incorrect, your cost of goods sold will be incorrect, your gross profit will be incorrect, and your net income will be incorrect. Accounting under a periodic inventory system, inventory is not tracked in the accounting system continuously. It only periodic means here a period means we only calculate either at the end of the month, at the end of the quarter, or at the end of the year. The beginning inventory balance is carried just like we do in perpetual until the end of the period. Purchases are accumulated during the period and the ending inventory balance replaces the beginning inventory balance. Again, we use the same first in first out method, last in first out method, and weighted average method in this case. So again, if you have any question on this topic, please let me know. And I will be happy to answer any or all your questions. And please let me know what do you think about these videos. If you have any suggestions for me to improve these videos, I would really appreciate it. Thank you for watching this video and I hope to see you in the next video.